Delta Airlines reported yesterday and went up by 3% on pre-market trades. And here are people who expected exactly that. $38 target was the most popular among options traders. How did they do that? Welcome to our earnings season preview. I'm Josh, presenting for Visual Sectors, and I will explain the trends of the coming weeks. In the next 10 minutes, we will cover how the sectors are positioned ahead of their earnings reports, which indications are worth watching, and a bonus, how to get some amazing free data from popular platforms. Let's start with the first sector to report. The financial sector was under pressure this year. It never really recovered from the March banking crisis. Fundamentally, the key problem didn't go anywhere. Let's briefly look at what's going on. The big banks hold $3 trillion of the Treasury securities, which accounts for 22.5% of the assets and trails up to $90 billion of unrealized losses. Not too much compared to the cash assets of $1.6 trillion. Looks pretty safe to me. They can hold those to maturity. Of course, the spread between borrowing rates and Treasury's income is pressing the profits, but analysts expect financials to do extremely well. Next week, we will continue our journey in the world of events that matter. After having talked about news reaction, the next video will be about how macro indicators actually move the markets in the short, mid, and long term. Some of the correlations are mind-blowing, so please subscribe and join next week. FactSet reports that the expected year-over-year earnings growth in the financial sector will be 8.7%, and the insurance industry will skyrocket with 64%. That is why the XLF options flows show massive optimism in the last 30 days, with $36 and $40 price targets acquiring extra 9,000 contracts, an equivalent of almost $30 billion in notional volume. The 4% bounce back in the ETF price seems like a fair reaction, but bear in mind that in the last 5 days, the sentiment has changed. Now, the same amount is flowing into bearish $30 and $33 price targets. So what should a trader do in this situation? The best guess is take profits and watch the key factor unravel. If we look at what was discussed lately, it has to be the delinquencies. How many loans are not paid on time? Is the number growing in mortgages? If it does, we might be on the verge of a full-scale real estate crisis. So yes, caution is reasonable. Let's look at the other sectors now. Here is our proprietary map of sector sentiment based on options activity. Every single sector ETF has faced an outflow in the last couple of days, with utilities and financials showing the worst performance. Here is an example of how resistance has been building up for the technology sector. The ETF has the ticker XLK. XLK is up 41% year to date and has built a solid support in October, expiration at $170 and a promising upside at $188. Look at the numbers. In the last 30 days, traders have been going all in here. But this optimism is short term. January bets are quite mixed. 10,000 contracts bet on the bullish run extension, while another 15,000 are expected a downside reversal. So, which side should we take? The answer is in the macro trends, as usual. And there are 2 indicators I want to share with you. First, the guidances of the S&P 500 companies are woeful. A record-breaking 64% issued negative EPS guidance, well above 5-year and 10-year average. Management expects the profits to continue declining. Doesn't really make sense to me how we can have a growing GDP while the biggest companies are on the negative territory. Anyway, the best sector is real estate, while the worst are industrials, consumer defensive, and materials. The technology sector is following the 50-50 mixed approach of the option flows in the sector ETF, which is XLK. 23 negative guidances versus 22 positive. Go figure. Seems like we should go on a company-by-company basis. Or maybe we should look at the insiders and buybacks dynamics. Insiders have been pretty active recently. An amazing picture in technology. 236 insider trades, above 1 million last quarter, and only 4 buy trades. The pessimism of management is something else. Can you imagine that? $18.5 million worth of stocks bought by insiders of 3 companies, while 232 trades worth $1.7 billion were a sell. Insiders do not share the optimism of analysts, headlines, or whoever is talking on TV. The message is quite clear. But what about buybacks? Companies have cut their buybacks by 18% in the second quarter and continue to do so. This has been one of the biggest factors to drive stocks higher. But the cost of borrowing makes it unreasonable, so no help from this front as well. To summarize, let's say this earnings season is a great risk, while the reward is limited. Options traders are ones of the most well-educated about the market people, and even there we see a lot of confusion. If you still want to trade earnings report, here is a couple of small tips. Look for a 100% direction probability. Any doubt? Step away. Use gurufocus.com to study insider trading. Use Zacks.com to look for expected earnings surprise. ESP is a massive tool, but it is based on analysts' predictions, so it can be tricky. Use earningswhispers.com for what they call a whisper, a comprehensive analysis of 11,000 analysts' earnings take. Use marketchameleon.com to see how the stock actually behaved in the past, regardless of positive or negative report. And last but not least, go to visualsectors.com for one-of-a-kind option traders sentiment analysis. Link is in the pinned comment. Stay on the safe side with Visual Sectors.
Visual Sectors is the perfect answer to the win question. We help retail investors understand key trends in the market, and our data sets put a calendar date on them. We source the most complicated data from Standard & Poor's, FactSet, and Options Pricing Reporting Authority to turn them into easy-to-read charts with up to 72% win rate based on 10-year back test.